Hi there. Imagine a stock that gives you a 10% dividend yield, has lower debt than Wilmar or KLK, and quietly beats the industry in efficiency, yet barely anyone talks about it. While the spotlight shines on Wilmar and Sime Darby, there's a quiet achiever in the background, Bumitama Agri. Stay with me as we uncover whether this underdog is Southeast Asia's most overlooked dividend gem. Welcome back to Durian Finance. Today, we're breaking down one of the most efficient yet underappreciated palm oil stocks listed on the SGX, Bumitama Agri. And we're putting it head-to-head with Wilmar, KLK, IOI, Sime Darby Plantation, and First Resources. Subscribe and hit the bell so you won't miss next week's video on Top 3 Singapore. Quick disclaimer, this video is for educational purposes only. It is not financial advice. Please do your own research or speak to a licensed financial advisor before making any investment decisions. In 2024, Bumitama earned IDR 16.7 trillion in revenue, about SGD 1.45 billion, with net profit of over SGD 200 million. They delivered a 13.7% net margin, much higher than sector giants like Wilmar and Sime Darby. Return on equity? 17.1%. That's better than most REITs, tech stocks, and certainly better than palm oil peers. And their net gearing ratio is just 0.09x. That's clean, disciplined balance sheet management. In short, Bumitama is lean, profitable, and debt-light, exactly what you want in volatile markets. Let's line Bumitama up against its heavyweight peers. Bumitama crushes across the board, lowest valuation, highest ROE, and most generous dividend. And here's the best part. It's doing this while maintaining one of the cleanest balance sheets in the industry. Now, let's talk about what every smart investor wants to know: future upside. Bumitama isn't sitting still. In fact, they're planting the seeds, literally, for their next phase of growth. For 2025, they've committed up to IDR 1.5 trillion in capital expenditure. This isn't just maintenance. It's for high-yield replanting, new planting across 4,000 hectares, and full-scale deployment of custom-blended fertilizers through their newly acquired subsidiary. That means higher yields, better margins, and less reliance on volatile fertilizer imports. Production is forecasted to rise up to 5% this year, timed perfectly with elevated palm oil prices and Indonesia's aggressive B40 biodiesel push, which is eating up local supply and supporting prices. In short, more output, higher efficiency, rising demand, and better pricing. That's a rare alignment of tailwinds you don't see often in this sector. Let's talk sustainability. Bumitama isn't just a high-margin machine. It's ESG forward too. They've installed methane capture systems that removed over 200,000 tons of CO2 and generate power for their facilities. They manage over 62,000 hectares of plasma plantations, way above regulatory minimum. And they've even launched a school empowerment program for local communities. In a world that increasingly rewards ethical sourcing, this kind of ESG leadership matters for reputation, risk, and long-term returns. What this means for investors. Here's the takeaway. PE ratio just 7.2x, value stock territory. Dividend yield of 10%, beats REITs and blue chips. 17.1% ROE, excellent profitability. Low debt and high free cash flow, resilient in downturns. Strong ESG story, aligns with long-term trends. Even after a drop in output due to weather effects in 2024, they recovered fast and ended the year with record revenue. And with palm oil prices projected to stay elevated in 2025, Bumitama could be in the perfect position to outperform again. So what do you think? Would you rather own Bumitama or Wilmar over the next 5 years? Drop your thoughts in the comments. Smash that like button if you found value. And if you want more deep dives like this, subscribe and hit that bell. Next week, I'm revealing undervalued Malaysian dividend stocks with 7% plus yield. Don't miss it.